Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. As promised, this is going to be a breakdown on US dollar, Japanese yen. On the previous video, when we were looking at CAD JPY, I mentioned that in the next few days, I'm going to be dropping this video on USD JPY. So we're going to be discussing two trade scenarios with a 1 to 52 risk to reward and one with a 1 to 50, both of which were analyzed not this week but last week, right around 8th, 9th of September if I'm not mistaken, or maybe just a little bit after if I'm not mistaken, 9th of September, right? So in this video we're going to be talking about distribution, talking about market structure, and being able to again catch very high risk to reward ratios or small stop loss trades. Currently it's Sunday 20th of September at just about 3:15 p.m. UK time, so the markets are going to be opening in the next about 7 hours or so. But before we get into it, disclaimers as usual. Everything you see in this video or in this channel for that matter is only for educational purposes. By no means requires any action. Any investments that you take is of your own risk. Understand that these markets are risky. They require a lot of practice, a lot of time being spent to master the concepts that you are working with. So don't expect to jump straight into it with these concepts and all of a sudden after a week become a multi-millionaire. That's just not how it works, okay? If you're not subscribed to the channel already, make sure to press that subscribe button to get informed whenever I'm posting a new video, especially if you are looking to elevate your trading game. But let's jump straight into it. I'm going to put this in replay mode on the 8-hour time frame. This candle that you see over here is a candle on the 8th of September, the 6 a.m. UK time candle. So let's speak about the higher time frame structure a little bit before we jump into the exact trade and the entries and the distribution and so on and so forth. Generally speaking, when you see this picture on the 8-hour time frame, what's actually telling us, what this picture is telling us, is this market is likely to have started a bearish trend. The reason behind that is, if you're looking at this from a smart money perspective, this move to the upside that we got over here was simply to maybe close this imbalance, maybe mitigate off of this institutional buy before you sell candle. How do I know that that's a buy before you sell or an institutional candle over there? Simply because once the market got pushed up over there, look how strongly it reversed straight away. This kind of gives it away, because as I'm looking at this, I'm realizing that, okay, this is potentially a move that the institutions wanted to buy it before they sell it, right? And if that's the case, especially if this move to the downside broke previous structure points, started to close below previous structure points, whether it be over there or over here, whichever structure point you want to look at, then it's, definitely in a bearish trend. Let me put it this way. So once this was kind of seen on the 8-hour time frame, this final candle was a candle that confirmed everything, because once we came back to mitigate all of these positions over there and markets started to go through this slowdown, this 8-hour candle is a candle that pushed down a full body candle, closing below all of these lows over there, which was confirming this kind of institutional move. From there, we jumped straight down to the 15-minute time frame. And on the 15-minute time frame, the area that was initially marked up is this red box over here. And this is where this picture comes into play, right? Again, 9th of September, this screenshot was taken. So this was last week, 9th of September, right? So that was the region that was marked up on the 15-minute time frame. The reason why this specific range was marked up on the 15-minute time frame is because, technically speaking, this is a drop-based drop. Or in other words, that could be another institutional candle in the middle of the range, right? So technically speaking, that's another institutional candle or range that we can potentially take trades based on. Now, I've spoken about this a lot in all of my trainings, in all of the previous YouTube videos that I have posted, that it's not like I identify a range or I identify a certain candle and I go ahead and blindly enter or set my limits. And nothing wrong with having your limit orders. It's just not how I personally would like to trade, because I still would want to see how the market reacts once it starts to approach that level. So let me take it off replay mode, and what we'll do is we'll put it back in replay mode as it started to kind of approach that level, right? Now, this is where this screenshot comes into play, because this is the screenshot that, this is a picture that kind of shows you this distribution starting to form as we approach that desired level. If we were looking to take trades based on this specific level, based on this 15-minute area, then technically speaking, entries would have been somewhere in the middle of the range with stops above. right? Or at the high of that range. Now that wasn't the case. We didn't actually wanted to / got any confirmations for us to want to take these trades based on that area. And the reason behind that is, even though if you're looking at it on the 10-minute or 5-minute time frame, we started to form this distribution, we never received any element of break of structure, right? So remember what we always say in regards to distribution. Distribution is not only a manipulation of the high, but what makes a distribution valid is a break of structure. So we always have to get, or at least in my case, I would always want to get a break of structure before I consider taking any trades, because it's that break of structure to the downside that will confirm these distributions, right? This distribution will get confirmed through that break of structure to the downside. So let's say you were looking at distribution schematic number 2. Where you had your preliminary supply, bias, climax. This down here could be looked at as your automatic reaction or sign of weakness. It really doesn't matter how you mark up a distribution. I don't want everyone to be so stuck in trying to actually mark up that perfect distribution based on all the schematics that you see. It's more so about the theory behind that distribution and what's actually happening in the market, right? So generally speaking, let's say preliminary supply, your bias, climax, your UT, and then potentially after that you said, okay, we've approached that desired level, so we want to see that last point of supply before we look to take these trades to the downside. If that was the case, you would have needed to see a break of this previous structure point over there. That was our previous major structure point. So if we did indeed break below this structure point before coming higher, then definitely I would have been looking at that as a potential last point of supply, but that never actually happened. Before that started to take place, this market started to go back up. So we never actually violated the previous structure points. Hence, taking trades based on that 15-minute region is now invalidated. The reason I'm speaking about this is because I know a lot of you who are trading smart money concepts or Wyckoff, sometimes it might happen that you're identifying many different imbalances, maybe you're identifying many different institutional candles within a range, and you're confused. You're thinking to yourself, which one of these institutional candles or imbalances should I be taking a trade based on? The answer is let the market talk to you a little bit. Don't be chasing this trade all the time. Wait until the market gives you a little bit confirmation. Wait for the market to tell you it's ready to go in a given direction before you take a trade. Because we never got that break of structure to the downside, technically speaking, this wouldn't have been a valid trade to take. That's not a valid distribution. Maybe the distribution is not finalized yet. Maybe the distribution is not finished yet. That is in itself a potential indication that we might just get this final spike up before this market comes down more. We might get that final UTAT, final upthrust after distribution to the upside before this market starts to come down, right? Now, once this general structure was seen alongside of this distribution, or the lack of break of structure was seen alongside of that distribution, we could indeed be looking at a little bit higher areas compared to where we initially looked at, to potentially identify better areas or better zones to take trades based on. And this is where the 4-minute and the 3-minute kind of time frame came into play. Right above that 15-minute region, we had this 4-minute institutional candle, or this 4-minute range. That's where this kind of box comes into play, from the low of that wick to the high of this wick over there. So the high would have been our stop losses, the low could have been areas for entry, right? That's in essence our final institutional buy before you sell. That's our final institutional candle, where this move to the upside mitigated this institutional candle in the middle of the range. The market dropped, mitigated it, and it continued to fall. So that 4-minute candle is standing out. That is a potential candle that we can take trades based on. And this was also complemented by this 3-minute imbalance that we got straight after. So this purple line that's identified over there, that's 50% of that imbalance on the 3-minute time frame, if I'm not mistaken. Yep, that's the 50% of this imbalance, more or less, and the 4-minute open price of that institutional candle. So that's where that line is identified, if that makes sense, right? So now that is a potential entry zone. That's an area that we can potentially look to take trades based on, especially as we approach that for the final push to the upside of that of that distribution over there. So that was that first picture of the distribution where we never got any break of structure to the downside. So that was practically invalidated. And once we mitigated that high level, the 3-minute, the 4-minute region over there, that could have been your entries there and then. That could have been where you would have taken your entries, with stop losses being at that high over there. Again, we can look at the exact figures. 106.295, 106.316, 106.295, 316, so on and so forth. And this picture was indeed taken on September the 10th, right? Now, I'll go into detail about this second entries over here. This is kind of what I want to really talk about, not necessarily the first entries over there. But that indeed could have been a little bit risky scenario, right? You might be wondering, again, up there, we didn't actually break structure to the downside, so how comes you entered it over there? The honest answer is that will be a little bit more risky scenario. Once you get a little bit more comfortable trading these concepts, you would be able to, you know, snipe it at that UTAD or at that spring instead of having to necessarily wait for a break of structure. But that's a conversation for another day, not something I would recommend necessarily focus on right now. In due time, these concepts take time to learn. Once we got that final manipulation to the upside, final push to the upside, that up thrust after distribution, now this is our newly, this is our new structure point, right? It's not over there anymore. That's the new structure point that has been created. So a violation of this structure point will be that break of structure. So once we started to break below this structure point, that was confirmed. That was done. Happy days, right? So that would confirm that distribution over there. We'll review everything a little bit, you know, towards the end of this video as well, just to quickly go through. I know I'm kind of going through these stuff very quickly, but we'll come back to it a little bit later on. Anyway, these second positions, those are the first positions over there. Again, September the 10th, the pictures were all taken practically on the same day. These second pictures are coming into play after we got that first entry over there, after that distribution took place and after we got this break of structure to the downside, right? Now, there's multiple different areas and lines that's kind of identified within that picture over there. So let's start to break them down one by one, and let's put it a little bit in replay mode over here. Okay. Now, these two lines over here were drawn based on a higher time frame, but for some reason I haven't written it down exactly what time frame they were. They were hourly, there is. So these two lines are indicating the open price to the 50% of this sell before you buy candle. This sell before you buy. Technically speaking, this is an institutional sell before you buy. That's the candle that, again, manipulated these lows and the market started to go higher. The open price to the 50%. Now, this wasn't a trade that I was willing to take to the upside. I didn't want to, you know, go against the higher time frame bias, but it would just be a good idea to identify where you would expect roughly the reversals to kind of take place, which was these two exact lines over here, where the expectation was for this market to push down a little bit lower to this desired level before going higher to our institutional area. And the other point was, if this market started to come lower and lower and potentially close below the 50% over there, again, let's go back to the hourly time frame. If this market pushed lower to close below the 50% of this institutional sell before you buy, then we might have just wanted to, you know, reanalyze these trades and see if you know, we would be able to take some better trades potentially, right? Now, what ended up happening from there is we did come back into that desired level. The market kind of rejected that desired level, slowed down a little bit. That 50% was rejected perfectly, and the market started to go a little bit higher, right? Now, before I mentioned about those entries over there, let's have a look at this picture again. This is on the 4-minute time frame that's taken, and the exact entry and the stop loss that's marked up for the second entries. Again, these are second entries. We already spoke about the first one very briefly, but as I said, I want to break down this second one in a little bit more detail. The entry and the stop loss that's marked up over there is based on this 4-minute institutional buy before you sell, which is also complemented by an imbalance straight after. It's a little bit tough to see it kind of in this picture over there, but that's another buy before you sell candle with an imbalance straight after. So let's go ahead and have a look at that over here. Go down to the 4-minute time frame and go back in time right over there. Now, that is the 4-minute buy before you sell, complemented by that imbalance straight after. That's the 50% of the imbalance, the wick of that 4 minutes. So you could have even taken trades based on the open price of the 50% of it. These specific trades were just taken based on the 50% of this imbalance. We could have been more accurate with having them at the 50% over there. That wasn't the case, at least with these specific trades over there. So Let's look at it right over there. Again, 106.253, 106.274. 253 and 274. All of that is over there, the entries, the stop losses, and so on and so forth, and the rest of it was just being patient for the market to approach your desired level for these secondary entries to the downside, right? So the rest of it is just have that patience, let the market do its thing, let the market approach. Let me go on a higher time frame. Let the market approach your desired entry level, and once it does, those areas could be your entries over there, right? Now, this was a trade that was a little bit annoying because of how slow it was moving, you know, especially before the week ended. Let me just make this a little bit bigger, easier to see on the higher time frames. There we go. Especially because of how slow this market was moving towards end of last week. But these trades were kept open over the weekend, just to you know, allow the market a little bit more time in its journey to the downside. Really, let me put it that way, right? The rest of it is just having that patience until the market gives you the distribution that you have already marked up. Take profits. The take profits for these trades were at these lows. The little tip that I'll give in terms of Wyckoff is the whole point of a distribution or an accumulation is for a distribution to create new lows and for the accumulation to create new highs, so long as the structure is also complementing your distribution or accumulation, right? So technically speaking, since we were on the right side of the higher time frame structure, then not only we could have the take profits at this low, but we could have it even a little bit lower. If you looked at this structure on the 8-hour time frame, right below these lows, we had another imbalance over there and another institutional sell before you buy. So again, some of you may have taken these trades and may have wanted to extend your take profits towards a 50% of their or towards a wick over there, which would have given you better risk rewards. That was not the case over here. We're looking at two trade scenarios, 1 to 50. That 1 to 52 was the first one, and a 1 to 50, and risk reward was the second one. And as I said, after that, just have the patience and let the market play out. Let the market do its thing. Let the market go in profit. And as you start to kind of see the market go in your desired direction as well, a practice that I would recommend everyone kind of start to do this in your own time to be able to master these concepts more and more is not to check your trades often, but come back to it after, you know, a few hours, or depending on the time frame that you're looking at Wyckoff, after a certain amount of time, come back to it and try and identify reaccumulations and redistributions in the journey, reaccumulations and redistributions as this market starts to make its way in your desired direction. Because technically speaking, for a market to you know, distribute and continue making its way down, chances are it's going to give you at least one other redistribution on its way down. So it's not just market goes up, distributes, come down, or the market comes down, accumulates, goes higher. Those are two scenarios for Wyckoff. We will have also redistribution and reaccumulation. Reaccumulation is something that we have spoken about on a couple other previous videos, so make sure to give them a watch as well. But within a distribution, chances are we'll get a redistribution after that as well. So try and identify these things. Try and look for these redistributions as the market kind of goes in your desired direction. Now, I know in this video I spoke very fast. I went through the information very quickly. The reason why I did that is because this trade scenario is very, very, very similar to Canadian dollar, Japanese yen in terms of the initial entries, in terms of the distribution, and in terms of the points of take profit, right? So, so long as you watch this video alongside of the previous CAD JPY video, then you know you have a much better understanding of these concepts on how to trade them. But I'm gonna just leave you with a few nuggets. This does bring this analysis to the end, but in terms of how to start to get better at these concepts, we always talk about back testing. We always talk about, you know, go back in the chart, you know, try and identify certain accumulations and distributions and see how it would have played out, or see how you would have taken the trades. The bottom line is, back testing, in my personal opinion, is not going to get you. It's not going to turn you into a better trader, because when you're back testing, technically speaking, there's no emotions involved. You have an idea of where the market is going straight after that. There's many different factors that will affect your live trading that is not going to come into play with backtesting. So when you go back in the charts, your aim isn't necessarily to get better at entries or get better at sniping or get better at risk to rewards or this and that. That's not the aim at all. The aim of backtesting, in my personal opinion, is just to get your eyes used to seeing schematics in this case, or seeing institutional candles candle imbalances, so on and so forth. So just to be able to have access to more data for you to identify maybe certain institutional candles, for you to identify, you know, imbalances or whatever else that it is that you might want to be working with, or, you know, Wyckoff accumulation and distribution. Go backing charts on different time frames to identify those. But if you want to get better at trading, something that I would recommend is forward testing. What I mean by that is the only and the best way for you to actually master these concepts and for you to get to become a better trader is not only to have access to good mentors. That's another very crucial part of this style of analysis, especially, right? Believe me when I say, without a mentor, without having access to people who've been, you know, continuously watching, continuously working on these videos, working on these concepts rather, not videos, working on these concepts for a long time, then it's going to delay your journey if you haven't got access to them, because you're going to make a lot of the mistakes that they have made. Whereas if you are working alongside of them, they would be able to tell you about these mistakes, and the best way I'm going to describe it is it would cut that 10,000 hour learning curve down massively, right? So that's a massive part of things, but forward testing is another big part of things as well. What do I mean by forward testing? Another way to describe it would be paper trading, right? So maybe you can analyze a few different currency pairs and a few different scenarios every day or every week, depending on the time frames that you look at, not necessarily executing them, but coming back to them and seeing how they have played out. Being organized with your trades is crucial. It's insanely important for you to have to be organized with your trade scenarios, with your entries, with your stop losses, knowing where you have taken these trades. The scenarios that you win, amazing. That's a nice scenario to study. The scenarios that you lose, which might be a lot, especially at the beginning of your journey of learning these concepts, you might find that you're losing a lot more than you win. That's okay, it's part of the journey, right? But those scenarios are going to help you with the learning massively, right? Because these are going to be scenarios that you can now come back to, study it, and for example, let's say this USD Jpy, let's say you analyze this, you paper traded it, and as the market started to make its way in a given direction, then you were able to maybe identify certain zones or certain levels that you could have potentially identified redistributions or drop-based drops or rally-based rallies or whatever you want to look at, in order to help you with future trading. So forward test things, okay? Analyze it in real time and put the hours when it comes to these analysis. In terms of spreads, that's something that I didn't mention over here. In terms of spreads, what I have said over here kind of applies the same, what I've said in the Canadian dollar Japanese yen video applies to USD Jpy as well. I spoke a little bit about spreads in the previous video, so go ahead and watch it. USD Jpy spreads are lower than CAD Jpy on our specific brokers. Again, raw spreads are true ECNs. USD Jpy spreads are 1 pipet or less. Majority of the times I look at it is flat. There's no spread at all, which is fantastic, right? So it makes these type of you know, high risk to reward trades kind of very easy to take, if that makes sense, right? Now, this video, as I said, was going to be short, sweet, straight to the point, but just to quickly sum it up, initially we looked at a 15-minute range for that distribution. The distribution was starting to form, but we never got a break of structure before we violated that zone, before we went higher, but we rejected off of a 4-minute institutional candle as the market started to reach a little bit higher. Once that happened, we got this break of structure to the downside, and from there, again, there was another 4-minute and 3-minute you know, area over there that we could have looked at for these secondary entries, with stop losses being at the high, and the rest of it was history, taking these two trades to the downside. The time span from where these first positions were entered until we hit these final take profits were just under 7 trading days, which again is amazing. Being able to catch a 1 to 52 and a 1 to 50 and the CAD Jpy, all of these were in the same week, right? In these 3 1 to 50 or above scenarios, to be able to catch within a space of 1 trading week, that's more than enough. That could be, you know, monthly return on investments made within a certain week, or whatever your targets may be, right? But as I said, I'm going to go through the cliche aspects of things as well. Take the time to learn these concepts. Reach out to the people that you know these concepts and you want to learn from them. Don't go through this journey alone. It will prolong it. And I'm not going to speak a lot more in this video, at least, about USD Jpy. But go and watch the Canadian dollar Japanese yen video, the previous video literally that I posted. The title is "Want to know how to stop donating money to your broker?" which is exactly what I mean, right? and all of the previous videos that have been posted kind of within these concepts as well to get a better understanding. If you have any questions, or if you want to know more about kind of what we do as a community of traders and how we help individuals to be able to get better at analyzing these concepts or become more independent in their trading, then feel free to reach out to me on my Instagram at PipsOfPersia. I'd be more than happy to answer questions. I'll be more than happy to help you out to the best of my abilities. But with that being said, I hope you all have had a fantastic weekend, and I hope you all are ready for the new trading week starting, as I said, in about 6-7 hours. Just make sure that as you're learning these concepts, you don't force your analysis. You're not trying to, see a range and say, oh, that's definitely a distribution. I'm definitely going to go ahead and sell it on my live trading account, and trying to, get these larger risk to rewards as quickly as possible. It's possible to get 1 to 50s, 1 to 100s, 1 to 200s, 1 to 500 risk to rewards. These risk to rewards are the type of risk to rewards that have been seen, that we've gotten ourselves as well. So it's definitely possible to do it, but it doesn't start there. You have to start with these lower risk to rewards first. Okay, so your aim at the very beginning could be, okay, do you know what? I'm gonna try and make it a little bit more accurate and take trades that are less than 30 pips stop losses. Then bring that down to 25 pips and 20 pips and 15 pips. And start to master it little by little, and before you know it, your trading game is going to be very much elevated. I hope this video was of value. I hope you all, you're watching this video, have gained value from this video. I hope this is going to help you in your, journey to becoming a good trader, full-time trader, or an independent trader. But as I said, if you are not subscribed to the channel already, do make sure to subscribe to be informed on other videos. I've got a few great ideas on other videos that I will be posting, some regarding trading psychology, hopefully within the next couple of weeks. But with that being said, have an amazing rest of your day, and let's catch these pips. Let's go.